My mate asked me the other day, what is the S&P 500 and why do people bang on about it? And that question sounds simple. It's one of the most misunderstood things in investing. It's not a single stock. Other people think it's only for Americans, and people that have actually purchased it don't know what they actually own. I'm Andrew Daw, a fully qualified financial advisor, and I'm here through 2026 helping people in the UK scale their finances. So in this video, I'm going to be breaking down exactly what the S&P 500 is, how it works, and why it matters. So now the immediate question is, what is the S&P 500? Well, it stands for the Standard & Poor, and it's an index. And an index is a group of companies that we track that meet a certain criteria, and we track their performance. And in this group of companies, in this index, it contains the biggest US companies. And some of these companies you'll know the name of, such as Apple, Microsoft, Amazon, Google, Coca-Cola, and Nvidia. And why it's so important is it provides a very good snapshot of how, one, the US economy is doing, and two, how the global economy is doing as a whole. Now, when people say they are investing in the S&P 500, they are likely buying an index fund or a form of tracking that index, which allows you to diversify your portfolio because you're investing not just in one company, such as Apple, but you're actually investing in 499 other companies. How do people invest in the S&P 500? This is where people get confused because you can't actually go out and buy the S&P 500. Remember, it's not a company, it's just a tracker. So instead, people invest through funds, usually index funds or ETFs, and ETFs are exchange traded funds. Now, S&P fund is basically a basket that holds shares or attempts to hold as many shares to track this index, and you're buying a small piece of every company inside all in one go. So instead of trying to guess, should I buy more Apple or should I buy more Microsoft or should I buy more Amazon, you're buying all of them at the same time. Now, most people do this with an ETF. That just means it's a fund you can buy and sell easily on an investment platform, just like a normal share. Now, the big advantage to doing this is diversification. It's the same logic as you don't put all your eggs in one basket. If you were to drop your basket, you would break all your eggs. If one company has a bad year, it doesn't ruin everything because it's only a small part of the overall fund. And that's why so many long-term investors use this approach. It's simple, it spreads out for you, and it removes the pressure of trying to pick up winners or trying to identify the winners, which is near impossible anyway. So the next problem you're going to face through diversification is you're heavily weighted into America rather than global. So you're very you're locked by region risk, but that would be a separate video. Now, here's something really important: not all of the 500 companies in the S&P 500 are treated equally. The index is often market cap weighted, which means simply the bigger the company, the bigger its influence, or the bigger the big amount of the pie will be taken up by this company. Now, I'll dumb this down with small numbers just so it's a bit easier. But if the entire S&P was worth £100 and Apple was worth £5, you would be buying 5% of whatever you put in to be Apple. Now, if that means you purchasing £200 of this index, you'll buy £10 worth of Apple, and it just keeps scaling up. So big companies like Apple, Microsoft, Amazon, and Google carry significantly more weight than smaller businesses within the index. And it's one of those, if one of those huge companies has a good year, it can lift the whole S&P 500. And we often talk about the Magnificent Seven. So that is part of the S&P 500. And if a much smaller company struggles, then it's not going to impact, it's going to be barely noticeable, right? And it's a bit like tug of war because the biggest companies have the strongest grip on the rope, but they don't control everything, but they do a lot of influence on the whole tracking of the market. This also means when you invest in the S&P 500, you're not putting equal money into all the companies. You're automatically investing more into the bigger ones and more into the established businesses than the less established and smaller businesses. The S&P 500 isn't a stock, and it's not a get-rich-quick scheme. It's simply a way to track 500 of the biggest companies in the United States and companies that shape the global economy. You don't invest in it directly. You invest through funds or ETFs that follow the index, giving you instant diversification instead of trying to pick the individual wins. Because it's market cap weighted, The biggest companies have the most influence, which means you're naturally tilted towards large established businesses that are already leaders in their own arenas. That's why so many long-term investors use the S&P 500 as core building block, not because it's exciting, but because it's simple, transparent, and easy to understand. And the most important thing of all, you're not going to be able to time the market. You want to be in the market for as long as possible. If this helps you, hit like, subscribe, and I'll be publishing more UK focused finance throughout the year.